This is Al Brooks. Thank you for watching the Brooks Trading course. This is the fourth of 4 videos on trading major trend reversal tops. Whenever you take any trade, you have to have an idea of what you're going to do when the market goes your way. You always have to have a plan to take your profits. I think it's very important to understand if you're swing trading to not exit if a reversal is minor. And I'll talk about minor reversals. Here we have a bull trend, 3 pushes up, 1, 2, 3, and a bear break below the trend line, a lower high major trend reversal here, and you have another entry right here. This is a 5-minute chart of the euro versus the dollar, and you're day trading. It's a 5-minute chart, and therefore a major reversal might not lead to a lot of pips. In this particular case, it led to 50, 60, 70 pips down, depending on where you took your profits. There are a couple ways to handle this. You can trade it like a scalper. You short, you take profits. You short, you take profits. You short, you take profits. The problem with that is you probably will get tired and you will not take all of the signals, and you might end up taking 2 10-pip scalps in a trade that would have netted you 40, 50, or 60 pips had you traded it differently. I talk more about this in the video on trade management and taking profits. Whenever you take any trade, the absolute minimum profit is always 2 times your actual risk. And when the actual risk is small, it's usually better to take profit at least 2 times your initial risk. Remember, that is your minimum goal, and it's a reasonable approach. If you sell below the low of this bar, you get filled right here. Your initial risk is just above the high of that bar. So this pink bar is your initial risk. This is 1 times your initial risk, and this is 2 times your initial risk. And look what happened when the market got down there. It bounced. That tells you that some traders exited at 2 times their initial risk. It's a reasonable thing to do. Some traders take half of their profit off at 2 times their initial risk and then swing the balance. Some will take another 25% off at 3 times initial risk and swing the balance. It's always reasonable to take at least some profit at 2 times initial risk. And if you're swing trading, you take your partial profits, you rely on your stop, and you hold the balance of your position until either there's a clear buy signal or until the end of the session. This is the end of the session, not a particularly clear buy signal here. This is a reasonable buy signal here, so it's okay to exit there, but this was not enough to make it always in long. Had you exited, you could sell again below this bear bar or below this bear bar. And then a micro double top, you could sell below that bear bar or below the neckline of this micro double top, which is the low of that bull bar. If you sold below the low of this bear bar, you get filled right here. Your initial risk is up here, assuming you use this for your stop. And then 1 times risk, 2 times risk. Here, you can take profits. If you sold below the neckline of this micro double top, you'd get filled here, and your initial risk might be up here. Certainly your actual risk is there, but if you chose to put your stop there, your initial risk is there as well. This is 1 times your initial risk, and this is 2 times. So a logical place to take profits. I don't want to spend a lot of time distinguishing initial risk from actual risk. For a trader's equation to be positive, all you need is a profit that's 2 times actual risk. However, if the actual risk is too small, you do not want to take profits at 2 times actual risk. And you never want to take profits unless the profit is at least 10 pips. That's the minimum scalp size trading Forex markets. If you plan to take profits less than 10 pips, you will lose money. After 100 trades, you can look at your account. Your account will be smaller than when you started. Regardless of the size of the initial risk and the actual risk, never take profits that are smaller than 10 pips in the Forex markets. Unless you have to. If your premise changes, you get out, even if it's 2 pips. But as long as your premise is still valid, you always want to take profits that are at least 10 pips. We have a bull trend with lots of reversals, so a pretty weak bull trend, and it's transitioning into a trading range. Again, this is the euro versus the dollar, 5-minute chart. Trend reversals often start in trading ranges, and this range is very tight. You can see it's only 10 pips tall from the bottom to the top of the range. If you get a trend reversal here, a major trend reversal, it could fall for a lot of bars, but not all that many pips. So you can get a major reversal where you make only 20 pips, but you're day trading and the range of the day is small and this top is small as well. Bull trend, so the reversal down is probably a bull flag, but once you get 20 or more bars in the trading range, the pullback from the bull trend, the probability of trend resumption up falls to about the same as the probability for trend reversal down. The market is balanced and the bears have become just about as strong as the bulls. In general, until there's a strong reversal, I always assume that the trend before has some significance, and therefore I always assume the probability is slightly greater for the bulls if the trend before the trading range was up. There's always going to be slightly higher probability of trend resumption than trend reversal, but every bar that gets added makes the probability closer and closer to 50-50. Whenever the market goes sideways for 20 or more bars, it's in a trading range, and there's always both a buy setup that is reasonable and a sell setup that is reasonable. The market's therefore in breakout mode. The bulls want a breakout and a measured move up. The bears want a breakout and a measured move down. For the bulls, it's a wedge pullback, a wedge bull flag. First push down, pullback, second push down, pullback, third push down, and a bull body. So they'll buy above this bar. They'll see this as a bull trend and a wedge bull flag, and they're looking for trend resumption up. We've had deep pullbacks all the way up, and the bulls are hoping this is simply another deep pullback in a bull channel that will continue all day. It's reasonable to take that buy, and once the market goes up here, it's reasonable to put your stop below the bottom of this wedge bull flag. On the other hand, what the bears see is a double top, maybe a slightly higher high double top, so a higher high major trend reversal with several tails up on top. They'll take that short, taking a chance that we'll get the bear breakout below the range and a measured move down, a swing down. This is a higher high major trend reversal. Bull trend, sideways to down for about 10 bars, trend resumption up for about 10 bars, pretty weak rally, reasonable to take the short for the reversal down, betting that it's the start of a bear trend. Bulls, they see trend resumption up and a pullback to a double bottom bull flag, and they have an IOI. They have an outside bar and an inside bar. They might buy this looking for trend resumption up again. Again, the point I'm making is whenever the market's in a trading range, there's always a reasonable buy and sell setup, and it is reasonable to be long holding for a swing up, and it's reasonable to be short holding for a swing down. You just take your pick. You cannot do both. So if you're willing to swing trade, you just place your trade. A lot of times, if you're swing trading and the market's in a trading range, you have to take 2 or 3 or 4 entries before the swing begins. A bull buying here, he might exit below here. He might buy again here and then exit here. Now we have 3 pushes up. A bear who sold here, he might exit here. He might sell again here. Trading ranges are always trying to break out, but 80% of trading range breakouts fail. A lot of traders prefer to scalp in trading ranges. They look to buy low and sell high and then take quick profits. This range is so tight, it's only 10 pips tall. I would not be trading it for scalps. If I'm scalping in a trading range, I want the trading range to be at least 20 or 30 pips tall. If I'm trading here, I'm only trading looking for a swing trade. The bears who did take this short never got out, and now they have a very strong bear breakout. Probably will get at least a small second leg down. Some traders don't want to take all these reversals, and they don't want to be exiting every few bars, making 3 pips, losing 3 pips. They instead wait until there's a strong breakout and good follow through, and then they short. But shorting here, their stop is either here or here. The stop is far away, so the risk is greater. However, at this point, there's a 60% probability that we're going to get at least a small second leg down. That's the trade-off. You wait for the strong breakout and follow through, you have a 60% chance of a second leg down, but there's less profit remaining in the trade, and the risk is greater. The stop is further away. Whenever you enter a trade that has a higher probability of success, you're always going to have a worse risk-reward ratio. Anytime you enter a trade where the risk is small and the reward is big, you have a great risk-reward ratio, but the probability is small. You cannot get both high probability and great risk-reward. That's a perfect trade, and it cannot exist. There has to be a reason for somebody to take the other side of the trade. If you get good probability, he gets good risk-reward, and vice versa. Strong bear breakout. Here's the breakout bar, the follow-through bar. Now we have a 2-bar breakout. The bears won, and the bulls are giving up. The bulls who did not exit, once they see this close, they know the odds are high we're going lower, and they'll sell the first reversal up, and therefore we'll probably get a second leg down. And the bears who did not sell will look to sell the first reversal up as well, concluding that we'll probably get a second leg down. Lots of ways to sell. You can sell the close of the follow-through bar. You can sell the reversal attempt, betting that it will fail. You can sell below the low of the reversal bar, a low one short. Here we have a double top short. You can sell there. Now you can call it a triangle, 3 attempts down, 1, 2, 3. You can sell there. We have another breakout and a pullback. This is a pullback from this breakout of this triangle. You can sell below that low. They'll sell at the market. They'll sell above bars. They'll sell below bars. You sell for any reason because you know the probability is high that we're going to get at least a small second leg down. Once the bulls see this, they know it's going lower. They're going to stop buying. They know we're going to get a second leg down. The market has to go lower to find a price where the bulls will buy again. At this point, we're getting a decent reversal. We have a 1-bar final flag. You can call it a wedge, 1, 2, 3. We have a triangle, often the final bull flag. We have a lot of trading range price action to the left, so this probably will evolve into a trading range. And this strong reversal up is a good reason for bears to take profits. The bulls see all of the trading range price action. They see the breakout below the bottom of the channel, and they assume the reversal up will be good enough for at least a scalp. So bulls will buy exactly where the bears are exiting, just above the top of that strong bull bar. Weak bull channel, lots of overlap. The market is reversing every few bars, very prominent tails, the absence of consecutive big bull bars. We have a good bull bar here, but then a small bull bar here, a good bull bar here, and then a bear bar. We have 4 bear bars and then a reversal up. This is probably a bull leg in what will become a trading range. And because it's probably going to be a trading range, even though it's a bull trend, bears will sell new highs and they'll sell reversals down. For the bulls, it's a bull channel. They might be looking to buy a resumption up, but consecutive bear bars This is a low probability buy. We have a tight trading range and might be developing a trading range. In any case, it's a weak bull channel. This is not a good buy. And if it's not a good buy, you'll have bears sell above the high of this bar, betting that the bull flag will fail and there'll be sellers above. A lot of traders don't worry about picking the exact top. Look at all the attempts at tops. The market keeps trying to reverse down. What they do instead is they sell for any reason and they use a wide stop, maybe some kind of a measured move up, and then they sell more if it goes higher. For example, here's the height of the range. So some bears, if they sell here, will put a stop above that measured move up, which would be off the top of the slide. And they'll sell more if it goes above the range, betting that the rally is so weak, it's probably not going to continue much further. And if it does go higher, there'll be more sellers up above. Some traders, if they sell here, they'll sell more on a reversal down. If they get out for any reason, they'll look to sell the next reversal down here or here, betting that the top of the trading range will hold and will test down to the bottom of the range. And if there's swing trading, at this point, you have a bull trend, a bear breakout, a resumption of the bull trend. We have a slightly higher high, basically a double top, and then a third attempt to break above the top of the range. Traders will either sell here for a slightly higher high major trend reversal or here for a slightly lower high, hoping for a swing down. Any of these shorts, if you take this one or this one or this one and you use an appropriate stop, has a 40% chance of a swing down, 60% chance of either a small loss or small profit. I want to talk about minor reversals. Every trend is constantly trying to reverse, and most of the reversal attempts are minor. They become flags and the trend resumes. 5-minute chart of the euro versus the dollar. We're trying to reverse down repeatedly. These are minor reversals. They become small bull flags and the trend resumes. These are not major trend reversals. They're minor trend reversals. Every trend is constantly forming wedges. We have a bull trend that are constantly forming wedge tops. But when the channel is tight like this, the tops are minor. They become bull flags and the bull trend resumes. They are not reversals. Do not trade them. Beginners love reversals because the risk is small. If you sell below the low of this bar, your stop is just above the high. So you get a wedge top, 1, 2, 3. They know that they're probably going to lose money, but they think, the stop is fairly close. I'm only losing a little. But if you keep doing that, you sell here, you sell here, you sell here, you sell here. Each of the losses is small, but they add up into a big loss. It's a terrible mistake to be selling wedge tops when the channel is tight like this. You should only be looking to buy. A beginner would look at this and say, okay, we got a bull trend, we got a bear breakout, we have a higher high, major trend reversal. No, it's not a major reversal. You only went sideways for 4 or 5 bars. The trend resumed only for a few bars. This is a minor reversal, and therefore it's probably a bull flag, and the bull trend will probably resume. You got a wedge top. Now you have another wedge top. No, don't take those sells. When a pattern is small, it's not major, it's minor. These reversal attempts are minor reversals, and they either become trading ranges or bull flags. When the pullbacks only have one bear bar and then a couple dojis, another small bear bar, this is not enough selling pressure to expect a reversal of the trend. Here, the bears have a decent sell signal bar, but the channel is very tight, and therefore the reversal is minor and probably not enough to make a profit selling with the stop below the low of that bar. Traders selling with limit orders at highs of bars are not making money. A bear selling at this high, lost money. Selling this high, lost money. Selling this high, lost money. And therefore, if the limit order bears cannot make money, the stop order bears are not going to make money. Traders should not be selling with stops in a bull trend until they've seen some evidence that the limit order bears are making money. Bears selling at the prior highs instead of selling below the low of a bar. If bears cannot make money selling at the top, it's much harder to make money selling below the top with a stop below a bar. Beginners keep selling and their losses accumulate. You bleed to death from 1,000 paper cuts. The bulls, on the other hand, are buying for any reason. They're buying closes, they're buying below bars, they're buying above bars. They're buying exactly where the bears are selling. They're buying where the bears are exiting with a loss. They use a wide stop and they scale in. A channel that's tight like this, no matter where you buy, your stop is down here. Your risk is big, but your probability of profit is high, and that's always the case. Bulls are buying below bear bars. They're buying below bear bars here. Buying below bear bars here, betting that all of these reversal attempts will fail. They're buying bear closes, betting that the bear breakout will fail and reverse back up. They're buying above bars, betting that if the market goes above a bar, the bull trend is probably resuming and the bears will give up. This is a 5-minute chart of the US dollar versus the Canadian dollar. Bull trend, pretty strong bear breakout, and then about 10 bars up to a lower high. This is a reasonable lower high major trend reversal, a reasonable short. A bear trend needs lower highs. They need a sell-off and then rally to be a lower high. They need a series of lower highs. Here we have a double top lower high, and if the bear is sold here, it's reasonable to put a stop just above the double top. If the market goes above this double top lower high, their premise of a bear trend is probably wrong, and therefore they no longer want to be short, so they'll exit above the double top lower high, especially after they see a double bottom bull flag. We have a bull trend and a sell-off to around 50%, and then a double bottom with that sell-off and a micro double bottom. The bears, if they sold here, do not want to see that. They'll either rely on their stop and get out above the top, or maybe they'll get out above this triangle. Reversal up, second reversal up, third reversal up with a micro double bottom, or they'll simply get out with a stop above this bull bar, or above the triangle. Can you hold short here at this point? You probably can, but you have to be concerned. You have a decent entry bar for selling below that bear bar, but the follow through is terrible. You have a pair of dojis, a micro double bottom, and a slightly higher high double bottom with this low. At this point, I think we have a double bottom, a breakout, and a pullback. I would get out of shorts at this point before my stop gets hit. It's only a few pips different. It doesn't make a difference. So it's okay to exit here or okay to exit shorts there. But in any case, the market is telling you that your premise is wrong. This is not leading to a major reversal. It's leading to a trading range, and it might be leading to trend resumption up. Leg one, pull back to a triangle, and then leg two. The bulls see the same thing. They see a double bottom and a pullback, and the lower high major trend reversal bears being trapped. The bulls will be buying exactly where the bears are getting out. For example, above this bar, or 1 pip above the top of the trading range. Can you reverse? Can you sell here and then go long here? Most experienced traders do not like to reverse. They'll do it sometimes, but usually they simply get out and then wait a few bars before taking a trade in the opposite direction. For example, if a bear sold here and gave up here, he might wait 2 or 3 bars and then buy over here. Whenever you enter any trade, You should always have a plan to take profits. Is your trade a scalp? Is your trade a swing? And stick with your plan. Also, if you're in a trade, a swing trade, do not exit with minor reversals. A minor reversal is exactly that. It's a pause in the trend, a minor reversal, and the trend will probably continue. I'm Al Brooks. Thank you for watching the Brooks Trading course. This is the fourth of 4 videos on trading major trend reversal tops.